Hello everyone. Hope everyone's staying safe in these unprecedented times with COVID and whatnot. We here in Melbourne are in lockdown at the moment, and I think all our friends in Malaysia are also on the same boat. I hope everyone's doing well. My name is Chay Winstanley. I am the compliance officer at QM Digital Exchange. I just want to go into a bit about my background. I have experience in law, practiced in commercial law, as well as insolvency litigation in that area. I also have experience in debt capital, so finance, and as well as equity capital, the capital markets, with the underpinning point being in regulation. So I'm proud to say that I was part of the team that did Australia and possibly the world's first IPO, which allowed the facilitation and acceptance of digital currency, cryptocurrency as part of the IPO capital raise to list on a securities exchange in Australia. So I myself am a crypto enthusiast, as I'm sure quite a lot of you are out there. And as I've seen this morning, the crypto markets are doing quite well. So let's all hope that it continues to keep going in the bullish direction so that we can all benefit. All right, so on to the next slide. Okay. So this presentation will be an overview regarding the anti-money laundering, which is abbreviated as AML, and counter-terrorism funding, which is abbreviated as CTF. So basically, if you combine it together, it's anti-money laundering and counter-terrorism funding. So why is it important? Because what we've seen is many criminal enterprises try to launder money through any avenues possible. And with the introduction of cryptocurrencies and blockchain, that has become the latest, let's say, attractive model for these criminals to try and launder their ill-gotten proceeds. It's important because a lot of these criminal enterprises which launder through cryptocurrency are involved in the drug trade, which is a significant problem globally, in child abuse, which I'm sad to have to bring up, as well as other things, including anything illicit. So traditionally, there were many avenues in terms of real estate, gambling, rather than online gambling, but offline gambling, casinos. But because of the introduction and the advent of cryptocurrency, this has become a point of significant importance. So we'll also be exploring how it's evolved, because what we're seeing now is the more usage of tech in the act of laundering ill-gotten proceeds, but regulators as well are using tech now to conduct better surveillance. This is done through a whole host of different new technologies, which of course some we're privy to and some we are not, to protect the methods that they use to catch these criminals. So a lot of platforms these days help exchanges like our own to flag transactions which we can then flag as suspicious, and not only do our sort of initial inquiries, but also relay that to the corporate regulator who's in charge of regulating the anti-money laundering space. So what we can see here is that as well globally, how the industry has evolved is that there is now more international global sharing. Whereas in the 90s and before that, it was a different story. Without the internet, it was more traditional methods, purely cash and all that sort of stuff. But these days, with technology, it's a double-edged sword for the criminals, because not only can you use technology to your advantage to launder ill-gotten proceeds, but the regulators and governments can also use technology to then counter surveillance and mitigate against money laundering. So to the next slide. So Points to those who can say who recognize this person when I switch the slide over. This is the famous Al Capone. So who is Al Capone? He was a notorious American gangster out of Chicago. He was the first person, or rather him and his accountant were the first to look at ways to launder funds so the government couldn't trace the source of the ill-gotten gains. So we'll go into his story a bit later, but firstly, I wanted to explain and talk about why criminals have to launder their money. So the reason why is because these ill-gotten gains are from illegal activities. Therefore, if they're introduced into the ecosystem directly, this could cause a problem for them, because then it's straight away counter surveillance can easily pick up on the illegal activity and track the transfer of funds. So there's a reason why they need to find ways to make sure that their ill-gotten gains are laundered into the system without being picked up by surveillance teams. So mostly, and not exclusively, but mostly the criminals who launder money through cryptocurrency, what we can see these days, it's from drug trafficking. So for example, the Silk Road, which was, and the darknet, terrorism. So terrorism is another aspect whereby many of these factions try to launder their funds through the system to hide the source and the use of funds. People smuggling, which is a very unfortunate big one as well. Arms trafficking, so illegal buying and selling of unregulated arms, as well as online casinos. What we're seeing a lot of these days are online casinos, which people can use their cryptocurrencies to basically gamble. And because it's in the cryptocurrency space, it's harder to follow and track, which makes it a challenging area. The key here for the criminals is obviously to mask the ownership of the funds and to make them appear legitimate across various sources. So that is their main goal and their main objective. So the key here is to avoid detection by them. So this allows them to then, for example, pay their suppliers or pay for goods, illicit goods and services under the radar and avoid detection from that aspect. One of the ways, obviously, is then if they park the money somewhere in a cryptocurrency wallet, and then once the heat is off, as so to say, they can then liquidate the cryptocurrency into fiat, and then use those funds to then, for example, purchase property or use those funds to purchase assets. So going back to Al Capone, he was a famous gangster out of Chicago, famous in the 1920s and the 30s for bootlegging, because back then in America, obviously prohibition was in place. So alcohol was prohibited, and he was selling bootlegging in the black market, prostitution, as well as gambling. And he was also famous for the Valentine's Day Massacre. Ironically, though, he was only charged with tax evasion, and that's how the authorities caught on to him and managed to prosecute him with a criminal sentence, which is quite ironic because of all these other crimes that he was involved in. So coming into the money laundering aspect of Al Capone, what the problem was, he was just making too much cash, which is a good and a bad problem for criminals. And his accountant was struggling to justify the cash to regulators, auditors, and so on and so forth. So what did he do? He bought a chain of laundromats, as they were a very cash-heavy business. And what he did was he used these laundromats as a front to introduce or place money into the system, and thereby legitimizing and masking its source being from the illegal trade. So what we can see here is, which is also prevalent these days with cash-heavy businesses, which is why regulators pay a particular focus to these areas, because It's a way for criminals to slowly introduce their ill-gotten fiat cash into the system through cash-heavy businesses. So that was what was happening prior. But with the advent of blockchain and cryptocurrency, we can see new ways criminals are now trying to launder. So blockchain. Blockchain was something which was a revolutionary piece of technology, which is the underlying pinning of cryptocurrency, the technology behind cryptocurrencies. So what we can see is, speaking of Al Capone, the days of the laundromat are long gone. But however, the principles of money laundering are the same. Criminals use any method to assist with laundering. So any new method that they can use to assist with their money laundering, criminals are quick to catch on to. Traditionally, as I've said before, a lot of the traditional money laundering avenues are cash-heavy business fronts, real estate property, as well as purchasing high net worth items in auctions. So for example, high net worth paintings, famous paintings, for example, your Van Goghs, your Picassos, and so on and so forth. However, with the introduction of blockchain, like I said previously, a lot of criminals are now turning towards cryptocurrency. Previously, it was very easy to launder funds through cryptocurrency, as there was very light and no anti-money laundering safeguards in place. So you could look at it as being the wild, wild west, where people were trading, using cryptocurrency to purchase illicit goods easily and freely with minimal detection and surveillance. For example, as I said previously, the Silk Road, which was a website where crypto, specifically Bitcoin, was used to purchase drugs on the dark net through Silk Road, through a browser called Tor. And basically what would happen is the purchase of the drugs through Bitcoin would then be delivered in the mail or under the radar. So actually, before I move forward, there's actually a movie coming out this year. I'm a big fan of learning through entertainment. So it's called Silk Road. I can't remember who produced it, but it talks about this particular scenario where people were purchasing drugs through Bitcoin, and the story of the founder of the website and how eventually he ended up being prosecuted by the authorities. So a bit of data. So the main data point in blockchain surveillance and tracking is Chainalysis. They provide a lot of data in regards to illicit wallets, illicit transfers of cryptocurrency. So in their latest report, what we can see is in 2019, there was a massive jump in terms of the amount of USD value laundered through cryptocurrency. However, we can see a massive drop as well in 2020, last year. So the question is, why is this trend now on a downward trend, and why was 2019 such a big trend? Well, what we can see is during 2017 and 18 was the Bitcoin boom, and I think after the crash of Bitcoin, a lot of regulators then had the opportunity to really sit down and think, well, okay, this is something which we need to start looking into seriously, and we need to start regulating. So in 2017-18, a lot of policymakers were reaching out to intergovernment agencies, to industry experts, to try and get some consultation in terms of what they should be doing in terms of regulating the cryptocurrency, as well as looking into how we can or they can mitigate money laundering. So in 2019, there were less the boom that happened in recently in 2020 hadn't occurred yet. So a lot of criminals, this was their go-to. And we can see that a lot of it, with the lack of regulation still in the transitional period and the period of flux, a lot of criminals were still taking advantage of the wild, wild west mentality and lack of safeguards. But it's come down in 2020, as we can see, for the following main reasons. So cryptocurrency related crime is falling because a lot of exchanges now are being regulated, as well as more countries are now regulating their digital exchanges, which means it's harder to onboard into crypto with cash and as well as offboard crypto into cash. Because of these safeguards with your identity requirements in place, it is now harder to launder ill-gotten gains. Also, a lot of platforms have now stricter onboarding requirements where a lot of people have to basically provide a lot of documentation before their business will be accepted. And also, even though there's a higher spotlight on the fact that cryptocurrency laundering is a big issue, the actual fact shows here in terms of the report that, well, actually, crime is going down because of regulation catching up with money laundering, as well as regulation now being implemented in more jurisdictions. So I just want to talk about here how crypto is laundered, or in fact, how any ill-gotten gains are laundered. So there's normally a three-pronged approach, which includes placement. Placement is the ability of introducing the ill-gotten gains into the ecosystem, and then followed by layering. Layering is where techniques are applied to disguise its true nature of the source of funds, and then integration. So integrating those ill-gotten funds after layering so that now the funds are deemed to be legitimate. This, in fact, is as a whole known as Smurfing, and is derived from the famous cartoon The Smurfs by a lawyer, a Miami-based lawyer called Gregory Baldwin, who was involved in a case in the 80s. As what would happen is one person would then use smaller entities to then spread the transactions and thin out the transactions through separate other entities. So these smaller entities being what he referred to as Smurfs, to then make the transaction. So going into the three main steps, we have firstly placement. This is where, as I said previously, criminal cash enters the financial system. So for example, here, the money launderer or the criminal collects cash selling, for example, cocaine. Now the money launderer has that cash, then they have to go through layering and integrate it so they can then prove that these funds are legitimate. So what they could do in the crypto example is they can go to an exchange, and then what they can do is convert that cash into cryptocurrency. There are still exchanges out there that can provide this sort of service to criminals in very suspicious jurisdictions. So that's how it's introduced into the ecosystem. And then the exchange, or the dark exchange, as I'll call it, will then transfer it to the nominated wallet address. So now that it's in there, obviously the person who obtained these ill-gotten gains will want to mask their identity and the source. So what they can do then is go into what's known as layering, and they can use intermediary services to hide the origin of these funds. So for example, like Al Capone putting the cash into his laundromats, the cocaine drug dealer could then put that cash into crypto, and then use that crypto to then layer into various different wallets, and then introduce that as legitimate. So other examples of layering include mixers and tumblers, which I'll go into in a second. Crypto gambling, where they use their cryptocurrency to then enter into online casinos to then mix the funds together, as well as privacy coins, which such as Monero, which hide a lot of the details that, for example, in Bitcoin, would be visible through the blockchain search. So you can actually go into the ledger, the public ledger, and search for that transaction, and it will reveal a whole bunch of information. Whereas in this particular scenario with privacy coins, a lot of that information is not available publicly. So finally, integration, and this is the legitimizing of the ill-gotten gain. So, for example, if the cocaine drug dealer had gone through, let's say, an online casino and had maybe made a slight loss or a slight gain, all of a sudden the casino is paying in more cryptocurrency, and then they can then justify and say, well, this was from casino winning, an online casino winning, and thereby trying to mask and conceal that from the regulators. So what I want to do, and I like to do this in my presentations, is make it entertaining. I know compliance is a very dry subject, so I've prepared, I've found a video just to talk about cryptocurrency in the layering phase about mixing, and as well as tumblers for cryptocurrency.
In May of 2020, hackers orchestrated a sophisticated attack on Binance, the biggest cryptocurrency exchange in the world. The attack resulted in the transfer of over 7,000 Bitcoin. The value of the Bitcoin at the time was around $40 million US, making it the third biggest attack on a cryptocurrency exchange to date. The Bitcoin was transferred from Binance's digital hot wallet to a pool of unknown digital wallets, presumably owned by the hackers. Experts from a research team in Luxembourg traced the transaction records of the unknown wallets and found that almost 5,000 of the 7,074 Bitcoin were being laundered through a service called Chip Mixer. But what does mixing chips have to do with laundering Bitcoin? Well, Chip Mixer is an implementation of a Bitcoin mixer. And what does a Bitcoin mixer do? Let's explain. Bitcoin itself is exchanged on a decentralized public ledger called a blockchain. When a Bitcoin transaction occurs, the transaction is recorded on a decentralized public ledger that is organized into blocks, which are chained together, hence the name blockchain. To the blockchain, a transaction does not occur between people, it occurs between addresses that look like this. And a digital wallet is essentially a container for multiple addresses, which is accessed with a username and password. The users connected to the addresses are anonymous, so although all transactions are on the public ledger, there's no way to know the identity of the persons who own the addresses. But the addresses will be very carefully monitored, so actually using the Bitcoin is not simple. The hackers need to either transfer the Bitcoin onto an exchange to be traded for fiat money, or the Bitcoin needs to be transferred to someone else in exchange for goods or services. Public exchanges implement something called KYC, which stands for Know Your Customer. This means that all customers on an exchange need to be strongly verified and associated with a real person. So moving the Bitcoin onto an exchange and exchanging them for US dollars would be a pretty bad move. The other option is to try and use the Bitcoin to purchase goods or services from merchants that have unregulated verification processes. So say you decided to spend the Bitcoin on the dark net to have some shady stuff shipped to your house. If the police catch the owners of the website, which they very often do, then they could be able to trace the transaction back to you. For these reasons, it is very important for criminals to obfuscate their addresses as much as possible. So this is where Bitcoin mixers come into the story. A criminal wanting to send Bitcoin from address A to address B cannot send the Bitcoin directly, because any investigator would clearly see that address B now owns the criminal Bitcoin. So the criminal uses a mixer service as the middleman. The criminal will start by making a request on the website of the mixer service. The service will then receive Bitcoin from address A and mix it with Bitcoin from other customers, as well as with Bitcoin reserves held by the mixer. After this is done, the mixer will send the Bitcoin to address B. Mixers charge a fee of between 1% and 3%, and the user has to send the Bitcoin to the mixer with no guarantee that the mixer won't just run away with the Bitcoin. But assuming that the mixer is legit and sends your Bitcoin through, there's still another big issue. The mixer is probably recording transactions, and this means that they will know the addresses of the source and targets of any transfer. So they may just sell this data, or they could be compelled by the law to share information. For this reason, the hackers will need to pass their Bitcoin through multiple mixing services to make it harder and harder to track them down. We should mention that mixers aren't just used by criminals. They're also used by persecuted groups and political dissidents that absolutely need the highest degree of privacy possible. So that leads us to our next question. Are mixers legal? Well, I couldn't find any situation in the world where mixers were explicitly illegal, but laundering Bitcoin definitely is. In February of 2020, a resident of Ohio by the name of Larry Harmon was arrested for running a coin mixer called Helix. He was indicted for money laundering conspiracy and operating an unlicensed money transmitting business. So mixing may technically not be illegal, but if your service is likely to be facilitating money laundering, then I'm not sure you do too well in court, which is probably why I couldn't find any record of who owned Chip Mixer or where they were based. As for the Binance hack, it doesn't look like there's any evidence to suggest that the culprits have managed to move the Bitcoin onto any exchanges. And the Luxembourg team have suggested that the hackers are still holding on to the Bitcoin. So, like everybody else, they hard them.
All right, so I hope that provided a bit of explanation regarding how mixers work. And as we can see, mixers basically aren't providing services purely to criminals, but they're likely to be used by criminals looking to launder the service, looking to use the service to launder their ill-gotten gains. So the service itself is not outlawed, but it's likely to be prosecuted by authorities if it's part of a conspiracy or found to be part of a conspiracy to launder ill-gotten gains. So next, let's have a quick look at how AML, anti-money laundering, is governed. So just an explanation, I like to call this the A team or the A-ML team. We have FATF, the Financial Action Task Force. They're responsible as the international organization for monitoring and also providing guidance and policies regarding anti-money laundering. There are member states which are participants of the organization. These include, for example, Malaysia, Australia, America, China. And their focus here is to focus on reform and mitigates against anti-money laundering and counter-terrorism funding. They will then provide recommendations and guidelines to the jurisdictional governing bodies, who will then work with the party in power to bring about legislation and improvements to the legislation to monitor and combat counter-terrorism funding and anti-money laundering. In Australia specifically, AUSTRAC, or the Australian Transaction Reports and Analysis Centre, is the main governing body which we report to. Basically, what we need to do as part of our duties is to register with them, as well as look into any transactions which we deem to be suspicious and report to AUSTRAC so they can conduct their investigations, inquiries. And they also work with policymakers as well to see if they can bring about changes, and they work closely with FATF as well, attending congregations, meetings, so on and so forth, to then bring about change and fighting financial crime. So how, what's in place to monitor and look out for suspicious transactions or suspicious individuals? So you could say it's a two-pronged approach. Firstly, we have Know Your Customer, KYC. This is mainly in regards to customers trying to onboard. So there's a set of standards that are set out in legislation, which states that identification needs to be identified and verified by, for example, us, a registered entity with AUSTRAC. Normally, this takes the form of 2 IDs, where it's either your passport or your driver's license, which are the most common ones. This is then checked against a database There are many providers out there who now link up to several databases and provide a very integrative technology platform which allows us to do our searches and to conduct our due diligence. So the first level for standard customers would be your customer due diligence or your CDD, and anyone who's high risk would fall under ECDD, which is enhanced customer due diligence. So this will involve more questions, more scrutiny, more searches, and more further inquiries into source of funds or the use of the funds. Main things to be identified are normally the address, the name of the individual, as well as the date of birth with government databases and records. This search, the KYC search, also screens for your PEPs, which are your politically exposed persons. So for example, government ministers, as well as sanction lists. So individuals, for example, who are based in countries where sanctions are imposed, such as North Korea. The other side of monitoring is monitoring, which is after the onboarding of the customer. It's called transaction monitoring. So in this phase, what we do is we look at the activity of the exchange, look out for unusual patterns of transaction activity. This includes the volume of transactions, its velocity, any structuring. So for example, micro deposits or micro withdrawals to avoid detection, looking into the source of funds as well as the use of funds. And if they're unable to justify, we aren't able to let them know that, that we're putting them under ECDD. But what we can do is lodge a suspicious matter report with the regulator to say that we have suspicions regarding this. It is not our job to investigate the suspicion. It's the job of the regulators to investigate that, but we have to be, under our obligations, we have to then provide anything that we deem to be suspicious. Another side of it is transaction threshold monitoring. So anything above $10,000 worth of value in Australian dollars will need to be reported in cash. But because in terms of the exchange, everything's to do with electronic payments, this is not really relevant to an exchange, as that can be traced from the bank of origin. Another factor to look at is the use of privacy coins. We at the exchange do not accept privacy coins or deal in privacy coins such as Monero. But what can happen is if we're given a report or some sort of analysis regarding a particular customer who has been using privacy coins, that would then push us to sort of shed a bit of light into investigating their account and putting them on enhanced customer due diligence processes. So looking at the future of AML-CTF, what does the future hold? I'd like to share another video which talks about how easy it is now these days for people to, and it's not just the regulators, but for anyone to really, with some starting data, look at investigating into suspicious transactions or suspicious money laundering activities. So I'll just share this video with you.
What is Bitcoin? It's a technology that enables people to move money around anonymously.
It's harder to trace and it's so anonymous.
100% untraceable.
People like to think that Bitcoin is anonymous.
Good afternoon.
But buried in last month's special counsel indictment of 12 alleged Russian spies is an explanation of how law enforcement tracked and identified the suspects using their cryptocurrency transactions.
The defendants used a network of computers around the world, and they paid for it using cryptocurrencies.
One blockchain developer was also able to trace Bitcoin purchases back to Russia's intelligence agency, the GRU, using only public information. He agreed to show Vice News how almost anyone with a Bitcoin wallet could do something similar.
It is not a good idea to commit crime with Bitcoin, because the moment you have one single weak link in your operational security, all of your history is now exposed. As we've seen in case after case, indictment after indictment, where they're shutting down drug trading, exchanges that are operating illegally. It's not just traceable, it's trivial to trace these things.
the Russian agents working on behalf of the GRU use Bitcoin as part of the Mueller investigation.
Exactly, as part of the Mueller investigation. It lists out several counts. Count 10 very specifically talks about how these Russian operatives from the GRU used Bitcoin, amongst other cryptocurrencies, to buy services needed to perform the alleged hacking. There was a very specific call out for a certain transaction amount that occurred on a specific date. And when you went back into the blockchain and looked at it, you can literally say, all right, there was a transaction for 0.026043 Bitcoin. That's a very specific number, right?
So you're saying that because you looked in the indictment and saw the exact amount of Bitcoin that they used, that Russian agent was the only one to spend that exact amount of Bitcoin in a 24-hour period.
Right, exactly.
At the time. What if you wanted to trace back my Bitcoin payments? Do you think you could do that?
And if you give me some starting data, yes.
So let's try it.
Okay.
So I think I have like $30 in Bitcoin here.
Sure.
So this Bitcoin here costs $4.95.
That's a very specific Bitcoin amount. It's already on the blockchain. This is the destination you sent it to. This is the address it was sent from. I can see that this wallet actually had transfers of Bitcoin from this wallet here, an intermediate wallet. This is not exactly a normal address. If you look at the number of transactions, it has 118 transactions related to it. And in fact, this looks like Coinbase. The first thing a law enforcement might do is say, okay, this looks like an exchange. I should go see if I have a record of this in any other transactions we've looked at. If it is an exchange, you go subpoena the exchange. Suddenly, I know your name and address because you had to submit your driver's license to start buying the coin in the first place.
So because all these transactions are listed and they're all verified by encryption and map,
Sure.
all you can really hope to do is obscure your footsteps, right?
Someone with enough time and dedication will be able to trace your path back.
Let's say I'm using Bitcoin, but I'm like, you know, the feds, they just keep getting me. What is better than Bitcoin?
Cash is probably your best bet for anonymity.
Why is cash better?
As in real life, if you go meet someone in a dark alley and you hand over cash and there's not a camera nearby, transaction is over.
So what we can see there is quite interesting. Even for someone who's not working with the regulators, with a bit of intuition, can look through the public ledger that is what premises the blockchain and see and track transactions and then follow the chain of transactions through the blockchain. So, and then a quick example I want to give you, a recent case study is the Colonial Pipeline case, where hackers used ransomware, whereby they basically shut down the pipeline in a pipeline which affected several states in the US. The companies paid the hackers in Bitcoin, which is what they requested for. And interestingly, the FBI managed to recover a significant amount of the Bitcoin that was paid by the company. It's interesting because, and paradoxical, because what we can see here is that the blockchain is, or Bitcoin itself is meant to be seen as this anonymous way of moving funds around. But on the flip side, we can see regulators are catching up using techniques to catch these criminals. And for me, and my opinion, this is a very good step in the right direction, because what we can see is, in essence, security. Regulator surveillance techniques and tracking techniques are improving. The regulation that's being introduced is doing its job, which is basically controlling not all the individuals who have the Bitcoin, but the bottlenecks where they have to on-ramp and off-ramp of cryptocurrency. And for example, like I said, making all these reports that we have to make to the corporate regulator, OzTrack, they can use that data to then piece the puzzle together and find these criminals.
What is a bit?
So I'd like to end on a quote by the famous former president of Mexico, Enrique Peña Nieto, where a lot of the cartels launder their funds through in Mexico. Money laundering is giving oxygen to organized crime. And what we're seeing here is a lot of regulators are starving that oxygen by controlling the bottlenecks being the exchanges. So restricting the supply of oxygen by basically monitoring where the bottlenecks occur. It's now harder to launder money because of this. And I think it's, in my personal opinion, inevitable, once governments decide to adopt a digital currency of their own, so in the future, there'll be no more paper currency, it'll be way harder to launder anything because everything is traceable. And because it's immutable through the blockchain, the records cannot be deleted, or it's very hard to hack and delete. And on the other side as well, tax avoidance will also be affected because now by then it'll be harder to hide any income from the tax office. In a sense, I'd like to round up this presentation by saying that I think what this does is that it makes the world a more safe and accountable place for everyone. And it stops the illicit movement of funds, which then could starve the oxygen from these criminal enterprises. And that concludes my presentation. Thank you.